Joining us, Jens Nordvig is going to undertake that project. He's the founder and CEO at Exanta Data and a co-founder and CEO at Market Reader, one of the very smart macro and micro minds. So I like your subject matter you're dealing with here. As in a report to clients, you talk about how you sleuth through the Nvidia earnings for macro implications. And now today we've got the Alphabet Nvidia partnership shining a little bit more light on where this is all going. Walk me through the process, Jens, that you're using right now to figure out whether or not this AI hype is really going to change the economy.
Yeah, so I don't think I've ever had a situation before where you go through an earnings release for one company to literally generate an input into a GDP forecast. But on this occasion, we did, right? Because the numbers and the growth that NVIDIA reported was so big that it potentially has implications for overall investment spending and overall GDP numbers, right? So when we look at all these AI effects and try to say, okay, what's the direct contribution to GDP in 2023, we get to numbers like 0.7. It's not a full percentage point, but not far off, right? So we're talking about pretty meaningful effects. The big question as an economist to figure out, okay, how does this work, is whether that spending that is happening in the AI space, is it coming out of some other budget, or is it in addition to what otherwise is happening in other budget? And that is a big question mark, and probably is going to determine whether this AI boost that you're seeing in certain sectors actually is an overall economic boost.
I love this, and I trust your analysis. You're not a hype guy. You're not big on, you were doing all the sleuthing for COVID numbers and stuff, giving us the raw data when we needed that, and so when there's so much hype in a sector like this, to get your take, I think, is refreshing. I mean, look, almost a percent of GDP points this year. That's non-negligible. How do we forecast beyond that to know what that becomes? I mean, 1%, if we hit like the Atlanta Fed 5.8, is less of a deal than if we're stuck at this quarter's 2.5.
Yeah, well, obviously, so there's been a lot of focus in the last couple of months on some specific data that has pointed to much, much higher GDP growth in the current quarter, right? And clearly we can have a single quarter where it annualizes to 4 or 5%. I don't think that has much to do with what the underlying trend is, right? So I think it's important to take a step back and think about where the economy is. And we're at this very kind of interesting point where the Fed has hiked rates really much more than almost anybody thought a year ago, right? And nevertheless, we have the economy kind of hanging in there, not showing any signs of acute stress, maybe with today's data being an exception, right? So we have this kind of tension between the Fed has done a lot, but we haven't really seen interest rate sensitive sectors and interest rate sensitive parts of the economy doing terribly. And I think that mostly has to do with there's just a long lag, right? A lot of people have a 30-year mortgage, right? They cannot see the high interest rate in their mortgage payments. A lot of companies have termed out that debt and have, rolled short-term debt into 5-year, 10-year debt. And it now takes a long time before that debt rolls into higher rates. So it's not that the economy is not impacted by, interest rates at the Fed level being more than 5%, but it just takes a long time to feed through. So think, even if the Fed was on hold here, we're going to see those effects of the past tightening come into the equation more and more in coming quarters. And I think the labor market data we had today is a very good first example. Last week, we had a good another example from the ISM data that also was viewed as a kind of warning sign about where growth is heading. And I think the most interesting thing in relation to the bond market that you talked about a lot in the introduction is that it seems to me that what really drives the bond market here is actually the growth news, right? Negative growth news has a big impact. Positive growth news has a big impact. And it's that growth trend that is actually turning out to be more important than the CPI numbers. The CPI numbers we've had over the last couple of months have showed a big turn. That wasn't sufficient to really change the tune in the bond market and the yield curve. but the growth numbers might be. So I think that's where investors should be hyper focused. Like, are we heading towards below trend growth or not? And I think gradually we will be.
So to connect this to the Nvidia point, it really brings up an important question that I find a lot of growth bulls have a little bit of a conflict in their thesis, because they say buy Nvidia, buy Tesla, buy all these AI names, but it's not just for the earnings growth. It's because valuations will also stay elevated because the economy will slow and the Fed will have to cut. So where does the impact of the growth potential on the economy of these AI disruptors have on the trajectory of those kind of lagged effects? Because I have a little trouble with the theory that, okay, I want to buy a stock like Nvidia because it's going to have all this disruptive technology that's going to change the world, but then also the GDP is going to come down and Fed's going to have to cut because we're in recession. Like, I have trouble marrying those, but I guess could you argue that it's possible?
So I think if we sort of look at this cycle globally, right, we've had a situation where the US was early coming out of the COVID lockdown, early delivering vaccines, early on reopening. And that meant that the US cycle was kind of leading. And now the reason why the US cycle has surprised so many people is that it has not really turned before the other economies in the world. In the last couple of months, we've had a clear turn in the European data. And it was really supposed to be the other way. It was supposed to be the US that came into the cycle earlier and turned earlier. And I think the AI, which is much more concentrated in the US than any other economy, has lengthened the US cycle, right? Because if we have that boost that I'm talking about, like maybe 0.5%, maybe a full percentage points of boost to GDP, it's just lengthened this cycle, meant that we couldn't see at the headline level the drag from the interest rate hikes. So I think that's very important. The Fed has a very challenging situation on their hands, right? It is a totally different cycle than any of the previous tightening/easing cycles we've had, in that it used to be always the case that inflation was really never a material issue, right? So as soon as growth really turned over, the Fed could get ready to ease, right? And that's not a luxury the Fed has in this cycle, right? Because inflation is so much above target that even if we do have pronounced growth weakness in the coming quarters, it's not obvious that the Fed will be able to relax quickly, right? And I think also, look at what's going on in the yield curve. We've had situations where the market priced 150 basis points of easing next year. We have less than that price now, right?
Pushing it back.
We've been going back, let's call it 100, 115 or something we have now. So we have this persistent expectation that as soon as growth flips, the Fed will be able to step in. And I think that's a real question mark if they can do that. And the follow on to that is that once growth turns, if the Fed is not cutting aggressively, clearly there's going to be risk assets, growth assets that are going to be under pressure from the Fed not delivering as quickly as currently is expected.
All right, Jens, really good stuff, and a timely conversation, making that connection about the extra boost that we're getting from the AI productivity. I know that there is another conversation within the subject of productivity and wages and the role AI is going to play there, but we're going to have to have that one next time. Great stuff, and appreciate the commentary as always. Thanks for being here, Jens.
Thank you very much.
Mr. Nordvig is founder and CEO of Exanta Data and market reader.